So yes, there's been some confusion about this equation versus what I showed you last week. So the bottom line that I want to tell you is that what I was explaining to you last week is would give you the identical outcome to what that equation is. Okay? So this is how I teach statement of cash flows. I teach it on intuition. Okay? And this is how most people that I've worked with and know do statement of cash flows. Okay? That doesn't mean that if you want to memorize a formula and that helps you to figure out statement of cash flows, more power to you. Okay? What I will tell you is that if you only focus on memorizing a formula and not focus on any intuition, there will be many situations with statement of cash flows that come up that may not fit into an equation that you have to then think about. Okay? And what I think, and I actually didn't look at this with you, the statement of cash flow equation you got, I believe, is for the indirect method only. Okay, so what we were talking about, so then I was getting myself confused because I was like, what we were talking about was actually the direct method, not the indirect method, and we started getting on a discussion, I think, that took the indirect method and the direct, so I think that's why I realized there was some confusion about direct versus indirect methods within itself. But, so just, I don't want to, without getting too far ahead, in the investing section, do you remember what I told you to think about when you think investing section? Non-current assets, okay? And so I had said things like proceeds from sale of a fixed asset, okay? Actually, I even have it right there. Think non-current assets, okay? So I had, what had happened last week, I look at this very simply, and this is intuition versus formula, okay? So when I say proceeds from the sale of an asset, if you sold an asset for $80,000 that has a basis of $90,000, what did you sell it for? It's a really simple question. If you sold an asset for $80,000 that had a basis of $90,000, what did you sell it for? $80,000. That's what goes in the investing section of the cash flow. The way, with a formula, you have to take the basis minus the loss. 90 minus 10 gives you 80. It's exactly the same thing. That's what we were talking about last week. Okay? I'm just looking at it very straightforward. Intuitively, what did you receive? That's it. Okay? So again, that's how I do it. You have to do what works for you. In accounting, there's lots of different ways of doing something. Okay? I don't know what the best answer is. I can tell you how I do it. I can tell you how I've seen it done most of the time. Okay? So, so getting started again, so I want to go back over just the basics without getting into all the discussion of statement of cash flows and the different reasons that cash flow is important. We have here 3 sections: operating, investing, financing, OIF, right? They're always in that order. And when you have operating, you want to think of net income. You want to think of current assets and current liabilities. When you think investing, you want to think non-current assets. And when you're in financing, you think non-current liabilities, stockholders' equity, and dividends paid. So that will help you to figure out where things go. Any questions so far? Yes. This is overall cash flows. I haven't gotten into direct versus indirect yet. You need to know these, regardless of which method you're using. And let me ask you that on that topic, direct versus indirect. Which section is different? Operating only. Okay? But regardless of which section you're in, you still need to think these things when you're in each of those sections. Okay? So, direct versus indirect. Why is this not going? What on earth? Okay. So direct here, you're going to see things like cash received from customers, cash paid for administrative expenses. So when you think direct method, when you're looking at the direct method, what you're essentially doing is putting an income statement on the cash basis. That's what you're doing in the operating section. In the operating section, you're essentially putting an income statement on the cash basis. Okay? So you have to look. So there's a very different procedure for direct versus indirect, because on the direct method, you have to basically take an income statement and put it on the cash basis. And for the indirect method, you have to reconcile your net income to cash basis. You don't look at each individual line item and put it on the cash basis. You take your net income number and back out all the accruals to put it on the cash basis. Okay? And we talked last week about some of the benefits and advantages and disadvantages to each. A lot of you guys had said you thought that the indirect method was easier, which it is, definitely easier, and you'll see it much, much more frequently out there in the real world when you're doing accounting work, at least if we don't end up switching to requiring the direct method. Okay? The direct method is a preferred method, but hardly anybody uses it. I don't want to say nobody uses it because I have seen it, but it's not very frequently used. However, the direct method, like I said, is a preferred method because it actually gives you more tangible, usable information. This is how much cash we received from our customers, not this is the change in accounts receivable for the period. Okay? Although people who would be proponents of the indirect method, okay, would say that net income is our accrual basis number, and this actually reconciles back to cash. This is a totally different calculation that ultimately reconciles to cash, but doesn't take you from accrual to cash. It just shows you cash basis. Okay? And people who would say, also proponents of the indirect method would say, there's a reason we report on the accrual basis, right? The accrual is supposed to be a better method of reporting than cash basis. So why would you simply just report something on the cash basis? You should take yourself from accrual to cash. Okay? So again, just some reminder from last week. So, so let's move along from here. I want to skip this and just kind of, I want to skip the IFRS for now. So it's funny, I actually made a small change to this slide, and I will put this up. I looked at this and realized that this income statement was not actually put together properly. I don't know why, but it had some things in the wrong place, so I just kind of tried to fix it. So we have here an income statement and a balance sheet. Okay, and we're going to go through, we're going to start with the direct method. So the direct method, what kind of terminology would you see again in the operating statement for a direct method cash flow? Cash from customers,
Cash to suppliers.
cash paid to suppliers. So you're going to, so it's basically, and again, I said think income statement on a cash basis. And in the operating section, you're thinking net income, current assets, and current liabilities. And you had a question? Oh, my bad. Okay. On the direct method, what you're going to be doing is starting with the information on the income statement. So if you have to put together a direct method cash flow, in the operating section, you need to start with what's on the income statement. So your first step is to pull up an income statement if you're looking at the direct method. And you have to look at each item in the income statement, and you have to figure out what the corresponding balance sheet account is. Okay? So what essentially you're doing, you have to take each item on the income statement and put it on a cash basis. So right now, sales on an accrual basis income statement includes sales for which cash was received, and it includes sales for which cash wasn't received. Okay? And if cash wasn't received on a sale, what account did it go into? Accounts receivable. So you have to take your sales and you have to back out of your sales anything that's still receivable. Okay? And this is the methodology you need to go through for each different item on your income statement. So I had gone through this last week. I mean, I have T accounts up here. I don't know if that's helpful. I just wanted to have like different methods for you to be able to look this up. But if sales was 590, okay, and accounts receivable was 40 in the beginning and is 60 at the end, what was the change in accounts receivable? If it was 40 in the beginning and it's 60 at the end of the year, what's your change in accounts receivable? What's your overall change in accounts receivable? 20. Okay? So cash collected from customers is 570. Okay, so you have to back out the change in accounts receivable. All right, so what I was trying to do here, which again, I don't know, you can look at this and decide if this is helpful to you or not. I'm showing you the initial journal entry. What it would have been, you would have debited AR, credited sales. Once the sales were paid, you would have credited AR and debited cash. Okay? So ultimately, you end up really with a $20,000 change in accounts receivable for what's not yet received. With me? So you have 590 in sales. You would have received 570. Your end of year balance is 60,000. Your beginning of year balance was 20. Therefore, sales cash collected from customers becomes 570. Okay? So the next piece here, any questions on that? So direct method, you're taking each item on the income statement and you're putting it on what basis? Cash basis. Okay. So next, I have here cost of goods sold. I realize this should be changed. It should say like cash paid for merchandise. Okay, or cash paid to suppliers. Something like that, it should say. So cash paid for merchandise or cash paid to suppliers, whatever it is. That's what you're trying to get at. So when we buy supplies, there are different accounts that are impacted. So you're on the income statement, because I said when you're using the direct method, you have to look at every income statement item. So cash paid to suppliers, let me just back up here 1 second. Cash paid to suppliers, if you're looking at your income statement, which account would include payments to suppliers? COGS, right. I mean, I have it up there, right? But so we dealt with sales. Stuff we pay to suppliers is related to this cost of goods sold account. So we're going to start with cost of goods sold because we start with the income statement on the direct method. Okay? Now, if we pay suppliers for supplies, what accounts are impacted potentially? So we definitely know cost of goods sold, accounts payable, and inventory for stuff that doesn't actually get sold during the year. Okay? So again, intuitively, we can get there if you think about it. This is where we can end up. So if inventory goes up, think about the journal entry. If inventory goes up, you would have paid, let's just say you're paying for inventory. Okay, so you start with cost of goods sold, you add any inventory that you purchased, any increase in inventory during the period, and alternatively subtract any decrease in inventory. So whichever way it goes, any change in inventory. However, if you say, what's your cash paid for merchandise, you're adding any increase in inventory, but if you didn't actually pay it, if accounts payable went up, that means you didn't actually pay maybe for that inventory. Okay, so you have to subtract any increase in accounts payable or add any decrease in accounts payable because it could be that you paid something that was outstanding from a prior period. So the intuition here is you have cost of goods sold, you want to add you have to look at the corresponding balance sheet accounts. You add any increase in inventory, alternatively subtract any decrease in inventory. It will be one or the other. You are going to subtract any increase in accounts payable or alternatively add any decrease in accounts payable to come up with cash paid for merchandise. Okay? So now I'm showing journal entries here, which I actually really don't. I should really change this. So here, cash paid for merchandise, we end up at 319. When you add, so if we look here, we end up at 319. We have cost of goods sold of 300,000. We have a change in inventory of 14,000 and an accounts payable of 5,000. So let's look. So you have cost of goods sold of 300,000. Okay. We have an increase in inventory of 14,000, which means like the idea is you're thinking I paid for inventory. So inventory goes up. Cash paid to suppliers goes up. So 300 plus 14. And then alternatively, accounts payable went down during the period, which means you paid more than just that. You paid another 5,000. That gives us the 319 cash paid for merchandise. Okay? So what you always are doing, again, I want to repeat, you start with your income statement. You're going line by line here, and you are adjusting for the related balance sheet items. Okay? Are you with me so far on what I'm doing? Do you have questions on what I'm talking about so far? Okay? So, like I said last week, the statement of cash flow is more than anything else, is you have to think about it, what makes sense. Okay? Particularly on the direct method. Like the direct method, you are not going to be able to use a formula to figure it out. Yeah, I mean, there are little formulas I'm giving you, but you have to think about what the related accounts are. Yes? Yes. because you actually paid it. If accounts payable went down, think about what the journal entry would be. To decrease accounts payable, what are you doing? Debiting it or crediting it? If you're debiting accounts payable, what are you likely crediting? Cash. So cash went down. Right? So you want to think, you can think about this in terms of journal entries. What likely, if accounts payable went down, what likely happened? If inventory went up, what likely happened? You debited inventory and you credited cash. Or accounts payable, which is why accounts payable is a related account here. Got it? Okay? So you're using things that all fit together. The same way with sales, when you think about this, if we go back to like an easier one, which is sales, when you think about sales, if you make a sale, what are the two journal entries you could possibly make? You're crediting sales, you know that. What would be the debit side of the entry? Cash or accounts receivable. If you debited cash, you received cash. If you debited accounts receivable, you didn't receive the cash, so that sales number is on the accrual basis. You have to put it on the cash basis. So you're backing out those sales. So if accounts receivable, the change went up during the period, you back that out of sales. Okay? So next. So let's say, next we're going to look at, I want to get into intuition here. So next we have salaries expense. We have salaries expense of 216. What would you be looking for? What would be a related balance sheet account? Wages payable. If you had an increase in wages payable during the period, what would you do? Decrease the expense. I'm trying to get you to think, how do you put something on the cash basis? Because you have one of two things that could have happened. You could have debited wages expense and credited cash, or you could have debited wages expense and credited wages payable. Okay? This is cash basis. This is accrual basis. You have to back out the payable. So is there a wages payable up here? Can you even see that? Can't really see. Wonder if I can do... No, it's not going to work on here. Okay. There's no wages payable on here. Okay? So wages, it is what it is. It's 216 for the period. Now, depreciation expense. What do we do with depreciation expense? This is kind of a trick question. Nothing. Does it have any cash impact? No. On the direct method, you just ignore it. And that's important because it's not that way on the indirect method. Now, I want to continue down this road here for another minute, and then I want to, because the reason I'm not going forward to show you where it fits on the statement of cash, there's a specific reason why I'm not showing you that the 216 is the final number for wages, okay? So, next, gain on the retirement of debt, loss on the sale of plant assets. Do these have a cash impact? Where do we see the proceeds from the sales of these items? Investing or financing. Okay? So here, these again have no cash impact. But we do use them on the indirect method. On the direct method, we ignore them because they don't have a cash effect. And we're directly arriving. All we're doing is putting an income statement on the cash basis. That's all we're doing is an income statement on the cash basis. Yes? It will be either investing or financing. So these three items, depreciation, gain, and loss, are ignored on the direct method, but we're going to be used on the indirect method. Loss on the sale of plant assets. I'm going to put this correct slide up for you. I'll put the corrected income statement up for you, or I'll just put the new slides up, whatever it is. Okay. Now we have interest expense. Interest expense, again, what would be one of the two journal entries that you would make for interest expense? You would debit interest expense and either credit what? Cash or interest payable. You're starting to see a pattern here. So what corresponding balance sheet account are you concerned with to put interest expense on the cash basis? Interest payable. Here we have interest payable. Interest payable went down by $1,000. What does that mean? You paid more. So not only did you pay $7,000, you also paid another $1,000. So you have to add it. So your total cash paid for interest is how much? $8,000. Good. Next, we have income tax expense, $15,000. What are one of the two journal entries that you could have made for income tax expense? You could have debited income tax expense and credited cash, or you could have debited and credited income taxes payable. So is there an income taxes payable account here? Yes. Yes. And what happened? It increased by $10,000. What does that mean? You paid less, right? You actually, so you have a $15,000 expense, and the payable increased. So you have to subtract it. Okay? So like you can think of the journal entry here. I mean, this is, I'm trying to make this as simplified as possible. So if income tax expense is $15,000, somewhere along the line you made a journal entry to debit. You debited income tax expense, whether in one journal entry or multiple journal entries. You debited it for $15,000. So, and income taxes payable went up by $10,000. So somewhere along the line you definitely credited income taxes payable by $10,000, right? Does this journal entry balance? No. What probably happen with the other $5,000? You probably paid it. That's the idea here. So the idea here, of the $15,000, only $5,000 of it was actually cash. So if you take your $15,000 in expense and subtract the increase in the payable, you end up at that $5,000. You've now put income taxes payable on a cash basis. Does anyone have a question on what I'm talking about? Have I lost you? Should I go back over this? Cash paid for income taxes. That's on your operating section. Okay, I'm going to move forward for a second, then I'm going to go back. So let's look at that. We just went through a few numbers here. Oops. So cash paid for interest and taxes, I clumped them together. So we had $8,000 and $5,000. There's your 13 total. With me? That would be your operating section. These can be listed separately. I have them clumped together. They can be listed separately. Cash paid for merchandise, we went through. Cash from customers. Now, cash paid for wages and operating expenses was $218. What was the number of wages expense? $216. So why is it $218? That is the question. Right, there's something missing for $2,000 that we have to deal with, right? Even more simplified than that answer. That's a very good answer. It's even more detailed than what I was asking for. So here, we've now gone through. I said when you do the direct method, you start with the income statement. We basically worked our way down the income statement to every single line and determine whether or not it has a cash impact, and whether or not, if it has a cash impact, if there's a related balance sheet account. Now, we also, if you look here, we went through looking at the income statement, we looked at things that were happening on the balance sheet, all these accrual basis items. So cash, obviously, we don't incorporate cash into the cash flow. We arrive at cash. Like that is, that's the ultimate number that we're getting at. Accounts receivable, we dealt with through what was the corresponding income statement account? Sales. Inventory we dealt with, what was the corresponding income statement account? Cost of goods sold. Prepaid expenses. Did we deal with that? No. Things that make you go, okay. Or my phone goes off, okay. Oops. How do I turn that off? Okay. So prepaid expenses, sometimes you have items like insurance that you pay for up front that maybe you didn't expense by the end of the year. Maybe there was no expense for it. Maybe you prepaid an item. It's part of what your regular operations are, but you actually didn't have any expense, so you don't have an expense to relate to the balance sheet. So there is an additional step here where sometimes you have to look at what may be missing from the income statement that does have a cash impact, because when you prepay something, what happens? Cash goes down. I prepaid it. Cash went down. I actually paid a bill, but I didn't expense it. So that item has to be added to cash paid for operating expenses. So you have the 216 plus the change in the prepaid. Okay? Now, let's just continue down a little bit longer because I want to make sure I point out some important things here. So next, we have long-term assets. Did we do anything with that? Why? It's investing. Very good. That's what I was looking for. It's investing because it's non-current. We're only concerned with what's in current. So non-current wouldn't be impacted in the operating section. Okay? So I'm trying to get you to think and apply back to the rules that I gave you and the intuition that I'm trying to give you to go through a statement of cash flows. So now you look at the current liabilities section. You have accounts payable. Did we address the change in accounts payable? Through what? Cost of goods sold. Cost of goods sold. Interest payable. Did we address that? Through what? Interest expense. Income taxes payable. Did we address that? Through what? Income tax expense. Bonds payable. Did we address that? Why? Financing. Great. And same with stockholders' equity. So now you've methodically gone through the income statement in order. As I explained, that's where you start with a direct method income statement. You've associated it with its related balance sheet item. And then you kind of just did a check. You went through the balance sheet, and you recognize you've now accounted for everything once you dealt with the prepaid. Okay? So here, again, these you can look at if it helps you, but I feel like for the purposes of what we're doing here, it's more helpful to talk it through. Now we have cash received from customers. We agreed on how we arrived at that. That made sense. We got cash paid for merchandise. We agreed on how to arrive at that. What three accounts are in this one? Cost of goods sold, accounts payable, and inventory. So if I start with cost of goods sold, what do I do with an increase in inventory? Add it. What do I do with an increase in accounts payable? Subtract it, because that means I didn't pay. Didn't I just put that on? Oh, it was you. Oh, I was like, well, now I guess I can't say anything because my phone just went off. Okay. So that will bring us to cash received from operations. Any questions? Yes? Prepaid expense, here, cash paid for wages and operating expenses. So wages was $216, we added $2,000, now the total is $218. Okay? Because prepaid expense went up. That means we paid something. Any other questions?
Can you separate cash paid for wages and operating?
Yes, totally. Yes, absolutely. This is just clumped together. Okay? Any other questions? So I'd like to try and have you guys do one, very simple. Well, it's not simple, but I mean, without like a huge amount of information. So why don't we try, I added brief exercise 23-4. So take a look at brief exercise 23-4. Let's try this direct method income cash flow statement. In the operating section only, I think is what's having. Any questions on this, on the direct method operating section? Okay, so I want to make sure it's clear. Have I finished my statement of cash flows? No, what's missing? Right, the if and OIF, okay, is missing. So we did the O, we didn't do the I or the F, because we're not worrying about that right now because they're the same under both methods. I'm focusing on highlighting the differences now. We just went over the direct method. Now I'm going to go through the indirect method and how it's different. Okay? So let's take a look here. So on the indirect method, you have to start with net income. So even though on the direct method you look at the income statement, you start at the top of the income statement. Under the indirect method, you start at the bottom of the income statement. And that's the only time you're really using the income statement to start with. Well, it's not the only time, but look at the net income number, put that at the top of your operating section, and then pull up your balance sheet. This is important procedurally so that you don't get confused. You start with net income. You start at the bottom of the income statement, get your net income number, and then pull up a balance sheet. Now, we've pulled up a balance sheet. Here's the balance sheet here. We have, forget cash because that's what we're arriving at. That's what we're actually reconciling to. Okay? Accounts receivable is at 60. It was at 40. So accounts receivable went up by 20,000. This is a current asset that increased. Where do current assets go? Which section? Operating. Inventory. The change is 14,000. Also operating because it's a current asset. We're looking at changes year over year in our accounts. Prepaid expenses went up by 2,000. Operating. What else are we concerned with when we're looking at the operating section of a statement of cash flows? Current liabilities. Good. Hope it didn't give it away that I also wrote in operating. So accounts payable went down by 5,000. We have to account for that. Interest payable went down by 1,000. Income taxes payable went up by 10,000. All of these we have to consider all of these items when we're putting together our indirect method statement of cash flows. Now the question is, what do we do with those numbers? Okay? So I had told you my suggestion to you with understanding what direction assets and liabilities move is pick one in each area and know that they all work the same. So let's say we pick prepaid expenses. If prepaid expenses goes up, what happened to cash? It went down because what was probably the journal entry? You debited prepaid expense and you credited cash. So what that just tells us, we can intuitively figure out the rule. When an asset goes up, cash goes down. That's how we can arrive at how these behave for cash flow purposes. When assets go up, cash goes down. Alternatively, if you have an increase in a payable, in a liability, what probably happened? Actually, I'm going to use a loan because I think the loan is the easiest example. If a loan payable goes up, what happened to your cash? It went up because you took out a loan. So the idea is that if any liability goes up, cash went up. So if assets go up, cash went down. If liabilities go up, cash went up. These are the rules you need to understand in order to figure out a statement of cash flows. Okay? So here, we now know what we need to account for. As far as the line items, we know we need to account for current assets and current liabilities, and now we know how to account for them because we know how they behave. So here, the increase in accounts receivable is a decrease in cash. So let me actually back up here. Net income was $38,000 on that income statement. That was given. So you always start with net income. I said always start with the bottom of the income statement. So what are we doing here before I even go through line by line? Here we have a net income number that's on what basis of accounting? Accrual basis. We start with net income on the accrual basis. What do we need to do? Put it on the cash basis. So all of these accounts are accrual basis accounts. So we're taking out all of the accruals and leaving only the cash items remaining. Okay, this is the indirect method. We're just taking the bottom line net income number. We're not putting an income statement on the cash basis. We're taking net income as one lump sum and putting it on a cash basis, and backing out all of the balance sheet accounts that affect the accrual basis. So here, accounts receivable went up, cash went down. Inventory went up, cash went down, because all these assets act the same. Increase in prepaid expenses, cash goes down. Accounts payable went down, Cash also went down. Interest payable went down, cash went down. Income taxes payable went up, cash went up. Now, that's everything we went through so far. That's all the items that we touched on. Okay? But we're not done yet. I have 3 additional items here. Now, in net income on an accrual basis, we subtracted out depreciation expense to get to the accrual basis. To get to that net income number of $38,000, we subtracted depreciation, we subtracted some loss, and we added some gain on our accrual basis income statement. So I'm just going to back up for a second, just so I can show you and remind you of that. With all these T accounts that I'm not even looking at. So to get to that $38,000, we subtracted out depreciation, we subtracted out a loss, and we added a gain. That brought us to the $38,000. Do those affect cash? Do those actually affect cash in any way? No, so they have to be removed. So in the, here. So depreciation expense was subtracted, so we have to add it back. We have to just remove them. The loss was subtracted from the net income, we have to add it back. The gain was added, so we have to subtract it. So you're removing the non-cash items. So what you do is you look at the current assets, you take your net income, you adjust for the changes in your current assets and current liabilities, and then you remove the items that had a non-cash effect on your net income. Yes? Because you don't need it. You're not, here you're starting with net income, which includes depreciation, it includes a gain, and it includes a loss in that number. So to get to cash basis, you have to remove them. Do you start with anything on the direct method? You're not starting with any number that has it. You're simply re-putting together an income statement on the cash basis. So you just have to ignore it. They didn't affect cash, so you don't include them. See? So here again, we're starting with net income. Net income on the accrual basis includes depreciation expense, it includes a gain, and it includes loss. Okay? It includes all these items that didn't affect cash. So we have to remove them to get to the cash basis. Under the direct method, you're not reconciling from an accrual basis item. You're literally redoing your income statement as if it was cash basis. So you just don't include items that didn't affect cash. That's it. Yes?
Yeah, I think depreciation expenses, I understand it's non-current items, but for the loss and the gains, I don't think it's non-current assets.
Proceeds from those assets go where? From the sale of an asset goes where? Proceeds from the sale of property, plant, and equipment go where? Investing. Proceeds include both the asset's basis and the gain or a loss. So that you're incorporating that into the investing section.
So I think the reason for to add them back or subtract them because they are not included in the operating section.
They are non-cash. The gain itself is non-cash. The gain itself is just recognized. It's non-cash. So let me see how I can explain this. I understand what your question is. So if you sell, you sell like an $80,000, you sell something for $80,000 that had a basis of $90,000. Okay? So the asset comes off your books at $90,000. Okay? Cash you received was $80,000. So you have some kind of a loss from that sale of $10,000. Okay? That's a journal entry that makes sense, right? You record this, right? So the cash, how much cash changed hands here? $80,000. The cash effect of this transaction is $80,000. Do we all agree to that? The cash effect of this transaction was $80,000. In the investing section, what do you put? $80,000. You put the proceeds from the sale of this asset. You account for all of that $80,000 in the investing section. It's all in there. Simply, that's what I received for the sale of that asset. Does this loss have any other additional cash effect? No, it doesn't have any cash effect over what the proceeds were. So you have to take it, so if it was a loss, it reduced your net income, you have to add it back. Okay? And vice versa if it was a gain. There's no additional cash effect. So if you were to include it, I mean, the great thing about a statement of cash flows is that if you include the wrong item or you don't include the right amount, it just won't balance. You can't, your cash, we won't come to your ending cash. And you'll probably see, I mean, hopefully if you made a mistake, you made like 1, and then you go, oh, it's that 10,000, I incorporated, I didn't do whatever. Oftentimes there's more than one mistake, and you have to back things out and figure them out. But if you methodically go through and you follow the rules that I'm giving you and the intuition that I'm giving you, you should be able to arrive at what ending cash is. Okay? So this is just the operating section in itself. Are there any questions on the indirect method? Any questions on indirect method? So when you think indirect method, what do you start with? Net income. Then what do? Pull up your balance sheet and look at changes in current assets and current liabilities. This is for the operating section, obviously, only. And if an asset goes up, what happened to cash? Think about this. If the asset went up, cash went down. What example did I give you here? Prepaids, right? If prepaids went up, you must have paid something. You can use whatever asset you want, whatever makes sense to you. If liabilities go up, what happened to cash? Went up. Okay, so like a loan is an example, even though it's not a current liability, it's the easiest one to, they all act the same. And then once you do that, are you done? No, you have to account for items in your income statement that had a non-cash effect. So very common ones would be gains, losses, and depreciation. Amortization would be another. Okay, these are all non-cash items. Okay, thank you. Yes, I am now recording. So, as we said, 515A, indirect method cash flow statement. So, we start off again with net income. We add back our depreciation expense. So, I want to just briefly go over in the investing activities, the sale of the investments. So, why, first of all, is it in the investing section? Yes. Because it's long-term. It's a non-current asset. And that's what I said. Non-current assets would be classified in the investing section. If it was considered a current asset, then it would be in the operating section. You would know. The general assumption with investments is that they're going to be non-current. They're usually non-current unless you're told otherwise. If it says trading, then you're really thinking current. Okay? So with the sale of an investment, tell me what was one thing you would definitely debit when you sell an investment. You sell an investment, you would definitely debit cash. Tell me something you would definitely credit. You would definitely credit the investment. What else could be part of this equation? It could be. I'm thinking, could be accounts receivable if they didn't actually pay you, but in general, when you sell investments, you're going to get that money back from the brokerage firm, whatever it is that you are working through. I'm thinking loss or gain is really what I'm thinking to balance out this entry. So if you sell an investment, you have to take the entire investment off your books. So in this case, they took the entire investment off their books at how much? At $22,000. Okay, because they're taking the 74, you see you had 74 in the beginning, you have 52 at the end. So the entire investment comes off your books at 22, but you have a loss. So do you debit or credit when you have a loss? You debit a loss, and how much is the loss for? You debit the loss for $7,000. So that means how much cash must you have received? $15,000. So I just wanted to make sure I went over that specific. So here is the $15,000 for the sale of your investment, not 22. Okay. So you'll notice I've mentioned a few different times. I keep doing journal entries to try to show you what's the cash impact. So this is one way of approaching when you have a question about how something should look. One approach is to make journal entries so that you can try to tell, because this is the story of what happened. This story makes sense This might not make quite as much sense when you're trying to figure it out. So if you make journal entries, you can usually make some sense of what happened and what the cash effect was. Okay? Any questions on this indirect method cash flow statement? Yes? The sale of the investment here is always just the proceeds from the sale. Here, what happened here is they don't give you what the proceeds from the sale are in this problem, do they? They don't give it to you. So you have to figure out what the proceeds are. Okay? Which is kind of like doing the equation that you are used to or that you learned, right? You're backing into the proceeds by looking at what the change in the investment account is. So you sold the investment. That was the basis of your asset. And you take into consideration the loss, and I'm showing you how you make sense of it via journal entry. Get it? Okay? Other questions on the indirect method? Yes?
Are we going to have access to the slides?
I mean, the idea here, someone else asked me that question. So I can put these up for you, but the idea is that you're supposed to be practicing this and doing these. That's why I give you time during class, is because I want you to go through and do these. Because you're going to have to do them in your life. You're going to have to do them on the exam. This is how you learn things, is by doing them. So if you're writing out the answer that you think the answer is, this should simply be confirming it, or you should make adjustments to it based on what you see in the solution. So I'd prefer not. I would rather you be writing this down, because that's how you're going to learn it.
Are there some things that are subjective on it, like if we didn't say?
Yeah, I'm not going to penalize. What I want to know is that you have stuff in the right place and that you clearly understand what it's supposed to be.
So that whole adjustment to reconcile, that's not a necessary.
Well, no, that you really.
That you have to put.
To some degree, you really need to have that. That's the adjustments, because that's what you're doing. The adjustments to reconcile net income to net cash. You know, I'm not going to go crazy. For exam purposes, I just want to know that you understand where things go and you understand how they behave. That's really the most important thing to me. Okay. So, you know, all you're doing, adjustments to net income to arrive at cash for operating activities, you know, whatever it is, as long as it's reasonable, okay? Yes? Yes. No, because that's non-current assets, so then you would show it in the operating section. Other questions? Other questions? Yes?
Sale of investments, if it's a trading, you have to show the loss separate.
Yeah, actually, as I'm thinking about this, I think that goes in the investing section. The sale, the trading security, the loss regardless is going to have to come out in the operating section. The question is whether or not, I'm just trying to think about that. If you have a sale of an investment that's considered a current asset, I think, let me get back to you on that. I don't want to give you the wrong information. Let me check that. Okay. So the question that was asked, which I just want to make sure I'm giving you the right information. So here we have sale of investments, but this is where non-current assets generally go. If it's trading, then it's considered current assets. So my inclination would be to say that goes in operating. But I'm trying to think of whether or not I've seen that in operating or if I've only seen that in investing. So let me look that up and I'll get back to you. Okay? I don't want to give you, like I said, I don't want to give you the wrong answer on that. All right. So moving along to the next, to a direct method. Now we're into direct method. Did everybody spend the time and go through 23? What was it? 23.5? Hopefully yes, since I gave you such a long lunch. Or did we just take a longer lunch? Do you need a couple of minutes? Okay, take a couple of minutes because I want you to get something out of this. 5. So here we're preparing a statement of cash flows, okay, for operating activities. So remember, they're the same regardless of whether or not you use direct or indirect for investing and financing. It's just the operating section. So cash receipts from customers, you have revenue, and then you have to look at the change in accounts receivable. Okay, so here, the 862, you have your service revenue, and then you have accounts receivable went down, which means cash went up. So there's your 862, cash receipts from customers. Next, we have cash payment for operating expenses. So here, we have 624 as operating expenses on the income statement. Here, they're using accounts payable. Is there any cost of goods sold in this problem? So here, accounts payable is going with operating expenses. I mean, it's like you need to incorporate it. So accounts payable went up, which means the amount paid went down, so you subtract it. There's your 609. And cash payments for income taxes. So you have 40,000, which is your expense. You find the corresponding balance sheet account, which here is income taxes payable. Income taxes payable went what direction? Down, which means you must have paid more. So you add it. There's your 44.5 for your total of 653,500. So your net cash provided by operating activities is your receipts minus your payments. That's the 208,500. I hope that for some of you this is starting to, you're starting to see that some repeat, you're starting to make some sense to you. Okay? Yes? Oh, you mean like 862 minus 653? Yeah, well, this is just a computation. This is not actually on the statement of cash flows. This is how you arrive at these numbers. That's a good question. So does it have to be with a parentheses? I don't care. Okay? If there's not like an accounting rule that says if it's parentheses, it's this, as long as it's clear to me what you're doing, okay? So imagine this. So someone has to grade these. If they're difficult to grade, you're more likely to get it wrong. So make sure it's clear, okay, what you're doing, not ambiguous what you're doing, okay? But I don't care if it's got parentheses, if you do different columns. Those are all acceptable ways of accounting for things. I know some people will be very specific with how they want you to report things. It's just not my style. I more want to understand that you know that you understand, not understand that you, or both, I guess both of those work. So, okay. I'll leave that for a minute. And then I have another exercise that just kind of goes through what section things belong in and what direction. Would you like to try that? Get like a little practice? Okay. So if you want to start looking at brief exercise 23.3, brief exercise 23.3. Okay. Well, so brief exercise 23.3. Who wants to read letter A? Go ahead.
Purchase of land and building. And you said that was PI, cash payment and investing.
Good. Very good. Decrease in accounts receivable. Yes. Good. Very good. Next. Yes. Wait, you got to read it. Issuance of stock, cash receipt in the financing section. Good. Letter D. Yes. Go for it.
Depreciation expense, non-cash investing and financing activity.
Depreciation expense is added back. It is non-cash, but it gets added to net income in the operating section. Under which method? Indirect. And what does this specific question say? Indirect. If this said a direct method, the answer would be just ignore it. Or I don't know if that would be a choice, but that would be the answer would be something to the effect of just ignore it. Right? Not applicable. Right? Okay. And again, I see why you put investing, financing, non-cash. because that, again, that's that equation. I think that's that equation coming back. So, I just want to make sure that you get why you can use that, but you have to incorporate the asset, and it comes out to the same ultimate answer. Okay? Next, letter E. Yes? Cash receipt investing. Okay? So the proceeds, yes, go for it. Yes.
Sale of land at a gain. I have D and R.
Cash receipt investing. Which letter is that? RI, you have that. Deducted from net income in the operating section, which is D. You got it right. That was an excellent hard one, and you got it right. Good. What, do I hear confusion? There are two answers, right? Sale of land at a gain is the sale of the land. The proceeds from the sale of the land go into the investing section, right? But the gain is deducted from net income in the operating section. So there's two components here. Got it? Did I lose anybody? Do I need to go back over that? Huh? Because the gain is added to net income. So if you think about what goes into net income, in an indirect cash flow statement, in the operating section, you start with net income. So maybe I'll write this out. I feel like maybe visually. Okay. So let's just make up an income statement. Okay. You have sales for 1,000. You have cost of goods sold for 500. You have gross profit of 500. Then you have various other expenses. Okay, so you have operating expenses. I don't know, give me some operating expenses. Well, we have that's right here. Right, so you have your salaries, I don't know, I'm just writing out a few things. So you have, $50. You have depreciation for $50, whatever. Okay, you have, or I'll make it a different number. Okay, for 10. You have non-operating. And what kind of things would go in non-operating? Let's just do gains. Gain on sale of investment. How about that? Is that good? Rent revenue, right. There you go. So you gain on the sale of investment for 40. So what's net income here? 500 minus 50 is 450. 440, 400. Okay? So your net income is 400 on an accrual basis. We all agree this is accrual basis here. This is an accrual basis income statement. Okay? This number goes on an indirect cash flow statement. Can anyone even see where I just put that? It's so annoying. What can you see up to? Well, you can see up to depreciation. Well, below that, it's for me to start right. Okay, so non-operating says gain on sale of investment. I put 40, and then I said net income is 400. So you get the drift, right? So now here, if I'm doing an indirect method cash flow statement, what do you start with? What do I always say you start with? Net income. So net income is what here? 400. So you need to put this on, you need to reconcile this, you need to put it on the cash basis. So in that net income number are certain items that don't belong, that shouldn't be incorporated. Some of these items shouldn't be incorporated because they're accrual basis, you have to back them out, like the portion of cost of goods sold that's in payables or inventory. Salaries, if there's something payable, still doesn't belong there. So these are the increases and decreases in payables. And then you have these miscellaneous items that affect net income, but really don't have an effect on cash. Depreciation is one of those things. So you have here net income of 400. What did depreciation do to net income? It decreased it. Without depreciation, net income would have been 410. Okay? So by adding back depreciation expense, in the operating section, by adding back depreciation expense at, what did I have it at 10, I'm putting net income back to where it would have been if you didn't put it in. It would be 410. So you add back things that were reduced, and you reduce things that were added to the net income, like gains. Oh, did I subtract the gain?
Yes.
So make that a loss. Just make that a loss. Thank you. I made it up like in 1 second. Okay, give me a break. Thank you for telling me. That should be a loss. That's correct. Okay. Otherwise, you would add. You got the drift? Does that make more sense now? So if you make an income statement on an accrual basis, that's the number you're starting with. You have to put that net income number on a cash basis. So some of that is incorporating the changes in these accrual type accounts and all these balance sheet accounts, and some of them are just numbers that don't belong in there on a cash basis. If you were working on a cash basis, you wouldn't record depreciation. It's that simple. You wouldn't record things like that. You would only, because there's no cash changed hands. That's an accrual basis entry to account for the expense in each year that you use up that asset, okay, to satisfy the matching principle. That's why you have depreciation. If you worked on a cash basis, you wouldn't have to worry about that. So you have to add it back since you subtracted it. Gains would have to be subtracted because they were added. Okay? Okay. Yes. No, it's okay.
You would record the 40 in the, you would add 40 to the operating and then,
Yes, if this is a loss, that would also be added back. The loss, just like depreciation expense, would be added back. If it was a gain, then it would be subtracted.
and then what would go in the invested? 40?
No, the sale of the actual proceeds from the sale.
So,
I didn't give it to you.
okay.
So if you sold an asset for $100 at a $40 loss,
100 goes in investing?
then 100 goes in investing. Okay? Okay? Other questions? It takes a lot. Don't get discouraged if there's confusion. This is not a simple subject matter. This takes time to build up the intuition. That's why I want you to practice it. That's why I don't want to just give you the answer. I want you to look it up and practice it and write it down and try it. This cash flow statement is not a simple statement, particularly on the direct method. Okay?
You would add the 40 in investing, but you wouldn't subtract 60 instead of 100? I'm sorry, you would add the 100 in
The proceeds from the sale of an asset. Those assets are non-current assets. So the proceeds from the sale of those assets go into the investing section. The gain or loss is in the operating section.
But you wouldn't subtract that
No,
again.
no. That's what keeps coming up over and over again. You do not subtract the gain. What you learned in your last class.
Not the gain if it was a loss.
No. You don't do it again. It's the same. It would behave the same way. The gain or the loss would they would go in the opposite direction, but they would behave the same in the sense that you'd see them in the same places. So if you have a loss on something, you add, in the indirect method, you add back that loss in the operating section. You only show the proceeds from the sale in the investing section. Another way of looking at that, which is what I think is that per the equation, is that you look at what the basis is and then add any gain and subtract any loss. That would give you your total proceeds. That's all it's doing, is giving you the proceeds. Okay? Other questions? All right, let's keep going. Letter G. Who wants to do letter G? Yes. Go for it.
G is payment of dividends, cash statement, finance.
Good. Very good. Letter H.
Increase in accounts receivable would be D, deduction from net income in the operating.
Good. Very good. Letter I. Someone over here. This is the quiet section. Go for it.
Purchase available for sale investment.
Mhm.
And we had PI.
Good. Very good. All right. Yes. You want to do one? Oh, you have a question? Uh-huh.
You said
No. Available for sale, in trading is always current. Available for sale could be either, but usually you defer to it being a non-current asset unless you're told otherwise. Yes. Next. You want to do one? I. Oh, Jay. Yes, go ahead. Good. Very good. This is good. Let's carry this over. I should put this on the exam. Everyone will do great. Someone over here. Letter K. Someone on the other side over here. Anyone? Yes.
Yeah, decreasing your account payable, deducting from net income.
Good. Very good. Next, letter L. Anyone? 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 Is that why no one's doing it? Go for it.
Loan for bank by signing a note, like a cash receipt and financing section.
Excellent. Go, Joyce. That was good. Huh? All right, next. Very good. Why is that non-cash? Use a note. Use a note. Good catch. That was a tricky one. Letter N. Yes, Carol, go for it. Good. Very good. Next. Letter O. Go for it. Which? Good. P. Retirement of bonds payable.
Yeah, retirement of bond payable, cash payment in investing section.
Cash payment financing. Why is that? Because it's a long, no, that's financing, right, because it's a long-term liability. Non-current liabilities go in the financing section. So you're starting to see if you follow those rules, everything fits, right? You're seeing where everything should be classified. So there are rules you have to follow and an intuition that you also have to get. Letter Q.
Okay, let's see if we learn. Okay. Sale of equipment at a loss. It's going to be A, you're going to add net income to operating. And then also, it's going to be RI, cash receipt, investing.
Excellent. You got it. Very good. We have learned. How we doing? We getting it? Yeah. Good. We're having like little clicks. That's good. Last one, purchase of treasury stock. Cash payment and financing. Good. Excellent. Excellent work. All right. So we're going to take a moment. That concludes. Well, actually, we have some ratio stuff in this chapter. Did I give you any homework on that? I didn't. You're doing it in auditing? Yeah, you are probably doing it in auditing because that's actually why it's really important because. Yeah, I mean, what I do want to make this comment. Okay, if you promise me that you're covering it in auditing, I won't spend the few minutes and go over it. Woo! All right then. Okay. Okay. We're going to go over this briefly. So the reason that these ratios are very important, so we, as preparers, we put together financial statements, right? Now this actually, let me look, actually, even if I go back further. So I'm actually going to go back just 2 slides for just a moment to risk analysis. So we prepare, as accountants, we will prepare financial statements. But it's also really important to understand the perspective of the user, which I've discussed before in this class, the importance of understanding the user's perspective. So people like investors and creditors who use the financial statements that we put together are not just going to, verbatim read each line and get all the information that they need. So in order to understand and analyze risks, investors and creditors may use ratio analysis as one method of getting more information from the financial statements. Okay? This is in your notes. This is actually going back to before statement of cash flows. Okay? It's in those same slides, but I had skipped them because I wanted to get to cash flows last week. So ways of doing financial statement analysis. So one thing is use comparative financial statements. So this is a big thing. And I think that just from gathering from the discussion with a couple of you at the beginning of the class, comparative financial statements, comparing prior year to current year financial statements is a very big method that auditors will use in order to just kind of get familiar with changes that may have taken place. Because generally, year over year, you anticipate that things will be sort of steady, right? That's one of the goals of accrual basis financial statements is you should be able to predict what's going to happen in the future based on the financial statements that you see today. Okay? And looking at comparative financial statements can also give you trends to help you help financial statements to be more predictive. So one technique you can use is to use comparative financial statements, year over year changes, percentage changes, things like that. And then other ratios, analyzing within that year's financial statements is another way. Okay, taking different information and looking at them together. So I'm not going through every possible ratio that you can do. I'm not, I'm just going to touch on the thing to cash. So what do you think, if you were thinking about ratios that involve liquidity, what kind of items are we looking at? Current, like short-term things that are probably current as opposed to long-term. So when you think liquidity, you're thinking stuff that's more current. In fact, I think I've already said most. Did I leave a lot of blanks on this slide too? Okay. Oh, I'll go back and can I move forward and then go back? Okay. I'll go back at the end. Is that all right? Okay. You got the gist of what I was saying, right? Good. So you can do a horizontal analysis. You can do vertical analysis. So horizontal, right, like horizon. You go across. Vertical, you're looking up and down at the same financial statements. Okay, and trying to analyze within the financial statement, within each year. Okay? You can do a vertical analysis and then a horizontal analysis, whatever works. So let me move forward with this. So working capital is taking current assets and current liabilities. Will give you a sense of how a company can satisfy its short-term obligations. So, if you look, so let's think about what some current assets are. What might be some current assets? Cash. What might be what? Accounts receivable, inventory. So. Right? And so current liabilities, what might be some current liabilities? Whichever is longer. Right? No, that's operating. Okay. So what you want to understand here, so this is our working capital, our current assets minus our current liabilities. Obviously, you want your current assets to be higher than your current liabilities. You want to know that you can satisfy your short-term obligations. So the current ratio divides current assets by current liabilities, so it gives working capital as a ratio so you can compare within firms. So it turns it from a number to a ratio. So you can compare how liquid is one firm versus the other. That makes sense. So you guys got here without, so you have these terms, current ratio, we're going to look at asset test ratio, but you got here, you were able to tell me that liquidity, you're really thinking of things that are current. Okay, you told that to me without even looking at this. So if you think about things that are current and you think current assets and current liabilities, you can express that as a ratio. That's all. Okay, and that allows for inter-firm comparisons. So the acid test ratio is a little more stringent. So are inventories and prepaids necessarily going to help you pay your bills really fast, even though they're current? So the acid test ratio is actually even a little bit more of a stringent measurement because it removes certain items like inventories and prepaid expenses from current assets before calculating your ratio. So if you look here, current ratio is current assets over current liabilities. Acid test ratio, or it's also called the quick ratio, is quick assets over current liabilities. So quick assets can be quickly converted to cash. Cash, short-term investments, accounts receivable do not include inventory and prepaid expenses. And again, as opposed to sort of like memorizing this just if you're in a business and you have to think, how quickly am I going to be able to pay my bills? You're going to look at the cash in the bank. You're going to look at the receivables that you're probably going to receive in the next 30 days. These are the things you're going to really care about. I can sell an investment if I need to and get cash. But you're probably not going to say, well, my inventory is convertible to cash. No, I mean, realistically, these are the things you would look at if you want to know what the cash you're really going to get fast. So even as an example, when I was living out in California working as a controller at this movie studio, we used to often, this used to come up when we wouldn't have a big movie, we would have cash flow problems. So I would have to make capital calls to the investors. They would ask me, how much working capital do you need? I wouldn't look at my inventory. I would look at my cash in the bank. I would look at my receivables. If I had anything I could, that was in the money market, I could quickly get to. But I would look at what bills I have to pay in the next 60 days, 30 to 60 days. These are the things that I would look at and say, okay, this is how much cash I'm going to need to cover. Okay? So it just kind of makes sense. So vendors, this is important. If a vendor wants to extend credit to you, they would be interested in these ratios. So potential investors and creditors, I just wanted to bring in some reality there. If you're an investor or a creditor might be interested in this type of ratio. And before they extend you credit and say you can pay me in 30 days, they want to know that you have enough money, that you have enough money to cover these kinds of things if they were to extend you credit. Next, I have here. Oh, did I need to stay there? That's okay. Can I move on? I want to just go right here to financing ratios. So financing ratios provide an indication of the riskiness of a company with regard to its ability to pay long-term debt. So we were just looking at stuff that was more current. Financing, we're thinking a little bit more long-term. So debt to equity ratio. Total liabilities divided by your equity. Times earned interest. Net income plus interest expense plus taxes divided by interest expense. So let's see what all of these mean. So let me see here. I'll start here with times earned interest. So times earned interest compares the interest on debt obligation. Okay, so what kind of interest do you have on your debt with the income available to pay those charges? Okay, so here we're looking at you are more well covered if there's income that's many times your interest obligation. So how am I going to say this? So you want to make sure that if somebody wants to provide financing to you, they want to make sure that you have income many times over, okay, to cover the interest that that you would have to pay on that loan. Okay, so this is something a potential creditor would be interested in looking at. Okay, so debt to equity ratio. If you want to invest in a company. If you want to invest in a company as an investor, Okay? Investors get a return on their investment once debts are paid off. Right? So you as an investor, if you're not going to be paid on your investment until creditors are paid. So a higher debt to equity ratio is more risky for shareholders. You want to have less liabilities versus your equity. Okay, so this is something a potential shareholder would be interested in. How long is it going to be? How much debt do they have before they're going to actually get to pay me? So the debt to equity ratio.